The price of financial convenience. It feels effortless now. Money moves instantly. Payments clear without thought. Credit appears with a tap, a swipe, a click. The system promises simplicity, but every layer of convenience quietly carries a cost we rarely stop to measure. To understand why convenience has become a hidden source of risk, we need to look at how friction disappeared from finance. What once required time, verification, and deliberate choice was redesigned to feel seamless. Speed became a feature. Ease became a selling point. Complexity moved behind interfaces built to feel simple, intuitive, and safe. This transformation reshaped behavior. When transactions feel effortless, they feel harmless. Spending increases when payment feels abstract. Borrowing expands when approval feels automatic. Risk feels distant when consequences are delayed. Convenience reduces awareness not because people are careless, but because the system removes signals that once encouraged caution. Institutions embrace this shift eagerly. Faster onboarding meant more customers. Simplified products meant broader reach. Automation reduced cost and increased scale. The system learned that removing friction increased participation, and participation became the measure of success. Each improvement felt rational, even responsible. But as convenience increased, transparency declined. Processes became opaque. Decisions were made by systems few users understood. Responsibility blurred across platforms, providers, and intermediaries. When something worked, it felt magical. When it failed, it was difficult to locate the source. Financial products followed the same path. Credit lines became flexible. Payments became invisible. Risk assessments became automated. What mattered was not understanding the structure, but trusting the experience. The system asked less from users, and in return, users questioned it less. Early benefits reinforced the trend. Access expanded. Inclusion improved. Transactions accelerated. The system felt modern, responsive, and empowering. Few paused to ask what had been traded away to achieve that ease. Convenience rarely announces its cost up front. Yet beneath the surface, the structure was changing. Decision-making shifted away from humans. Feedback loops shortened. Errors propagated faster. Small design choices scaled into systemic behaviors. What felt like comfort at the individual level became exposure at the system level. These early signals reveal a quiet tension. Convenience simplifies experience, but it also compresses judgment. It removes pause, but pause is often where resilience lives. And when a system is designed to make everything easy, it can become dangerously hard to slow down. Because the true price of convenience is not paid at the moment of use, but when the system is forced to deal with the consequences it helped us ignore. As convenience became the dominant design principle, the system quietly restructured how risk was introduced and absorbed. Decisions that once required reflection were reduced to confirmation. Warnings were softened. Complexity was hidden behind reassuring language and smooth interfaces. The easier it became to act, the less visible the trade-offs felt. Automation played a central role. Credit approvals were instant. Fraud detection ran silently in the background. Risk scoring updated continuously without explanation. These systems were effective, but they changed accountability. When outcomes were favorable, trust increased. When problems emerged, responsibility felt distant, buried inside processes no one could easily challenge. Behavior adapted quickly. Consumers responded to speed by acting more often. Small transactions multiplied. Short-term choices accumulated into long-term exposure. Because each step felt insignificant, the overall commitment was easy to overlook. Convenience did not create recklessness. It normalized accumulation. Institutions reinforced the pattern. Metrics focused on engagement, throughput, and growth. Friction was treated as failure. Any pause that caused hesitation was redesigned out of the experience. Safety was measured by system uptime, not by user understanding. Stability was inferred from volume, not from resilience. But beneath this efficiency, new vulnerabilities formed. Automated systems responded uniformly to signals, increasing alignment. Errors propagated faster because manual checks were removed. When conditions shifted, responses were immediate but not adaptive. The system could react, but it struggled to reason. Markets reflected this change. Price movements accelerated. Retail participation surged. Volatility became sharper, more episodic. Confidence rose quickly and retreated just as fast. Convenience compressed the emotional cycle of risk, amplifying both enthusiasm and retreat. Regulators observed these trends with mixed signals. Access expanded. Costs fell. Innovation thrived. Yet incidents revealed fragility. Sudden outages halted activity entirely. Algorithmic errors scaled instantly. Consumer exposure increased faster than safeguards evolved. Oversight lagged experience. Public trust remained high, but became passive. Users trusted the system because it worked, until it didn't. Few understood the mechanisms behind their financial lives. Fewer still questioned how much judgment had been surrendered in exchange for ease. This was the deeper buildup. Convenience removed friction, but friction once served as a filter. It slowed decisions. It encouraged awareness. Without it, the system moved faster than understanding could follow. The danger was not that finance became easier. It was that ease became indistinguishable from safety. And when convenience replaces comprehension, the cost is paid not by individuals alone, but by the system that must absorb their synchronized reactions. The conflict surfaces when convenience collides with uncertainty. A disruption hits, a system outage, a market shock, a sudden policy shift, and the smooth experience people depend on begins to fracture. Transactions stall, access is interrupted, automated responses trigger without explanation. What once felt invisible becomes abruptly present. Because decisions were compressed, reactions are too. Users respond at the same time, in the same ways. Withdrawals spike. Orders flood systems. Support channels overload. The very simplicity designed to help people act quickly now synchronizes their behavior, turning individual responses into collective strain. Institutions feel the pressure immediately. Systems optimized for speed struggle with volume under stress. Fail-safes pause activity, but pauses feel like failure in an environment built around instant response. Confidence erodes not because losses are extreme, but because reliability, once assumed, now feels conditional. Automation, once a shield, becomes a source of confusion. Algorithms act decisively, but without explanation. Risk controls trigger uniformly, freezing accounts or restricting access. From a user's perspective, the system appears arbitrary. Trust weakens when outcomes arrive without understanding. Markets reflect the same pattern. Retail flows surge and retreat in waves. Volatility intensifies as sentiment shifts rapidly. Price movements overshoot fundamentals, driven by synchronized action rather than informed judgment. Convenience accelerates emotion, and emotion amplifies instability. Regulators face a familiar challenge. Interventions must account for scale, speed, and perception. Restoring functionality is not enough. Confidence must be restored as well. But confidence built on ease is fragile. Once disrupted, it requires transparency and time to rebuild. Public reaction reveals the deeper issue. People are not responding irrationally. They are responding to a system that trained them to expect immediacy and certainty. When those expectations break, frustration replaces trust. The absence of friction leaves no buffer for adjustment. This is the heart of the conflict. Convenience removes pause, and pause is where adaptation happens. When systems fail quickly, users fail quickly with them, not out of fear, but out of habit. The realization becomes unavoidable. A system designed to feel effortless under all conditions cannot absorb stress gracefully. And when convenience amplifies reaction instead of understanding, it transforms minor disruption into systemic tension. The reckoning comes when a system is forced to admit that convenience is not neutral. It shapes behavior. It accelerates reaction. And when stress arrives, it determines how shock spreads. What once felt like empowerment reveals itself as dependency. In response, the system begins to rebalance. Designers reintroduce friction, not to frustrate, but to protect. Confirmation steps, slow, impulsive action. Transparency replaces seamlessness in moments of risk. The goals shift from making everything easy to making outcomes understandable. Convenience is redesigned to pause when it matters most. Institutions adjust their priorities. Engagement metrics give way to durability. Automation is paired with explanation. Systems are built not only to act, but to communicate. Trust becomes something earned through clarity, not assumed through speed. Resilience is measured by recovery, not by uptime alone. For users, the change is subtle but profound. Awareness returns. Decisions take longer. Expectations adjust. The system no longer promises effortlessness under all conditions, but offers reliability when conditions deteriorate. Confidence grows from understanding, not abstraction. Markets reflect this shift gradually. Volatility remains, but reactions soften. Participation becomes more deliberate. The emotional extremes fueled by instant action begin to ease. Stability is no longer driven by ease of entry and exit, but by confidence in process. Looking back, the lesson of financial convenience is not that simplicity is dangerous. It is that simplicity without awareness removes the buffers that protect systems under stress. Friction once served a purpose. It slowed behavior enough for judgment to catch up. The price of convenience is not paid in comfort. It is paid in resilience. And when systems prioritize ease over understanding, they trade short-term satisfaction for long-term fragility. Recognizing this does not mean returning to complexity. It means designing simplicity that knows when to step aside for caution. Because in finance, the most helpful systems are not the ones that disappear, but the ones that stay visible when things go wrong. So what do you think? Are we repeating the same mistake again? The price